In our previous webinar, we discussed about candlestick strategy, and we have actually given already the structure about the candlesticks. Okay, generally, what candlestick tells us is, in general, it's just like this. We have a candle like this. It is mostly telling us the opening price, closing price. You know, imagining that this is a bullish candle. So it means that the bottom part of the candle, the body over here, the market started its trading over here. Let's see. So this is the start, and then the market rose from here to the top of this shadow and made a higher, the highest high for that specific time frame, and then maybe it dropped, and this was the lowest low. All right, and ultimately the candle closed over here, and this is the close. Okay, so this is overall what candle is. All right, and it can tell us many different things. It can be like this. It means that the market found itself a resistance or support. It can be like this, or it can even be something like this. Okay, so if we have actually something like this, I would love to see it, because it's my favorite market setup. Okay, now I want you to see one important factor. Okay, in general, in pretty much every single trading style of mine, I used two moving averages. Okay, oh, sorry. So I use two moving averages. This is a one. Let's say this is the 50 moving average, and then we have another one. Let's say like this, and then this is the red one, can be our 200 moving average. Okay. Now, whenever both of these moving averages are showing upwards, which means they slope upwards, they give us an overall structure of the market which is upwards. They are showing up. Let me put it this way. By the way, the 50 and 200 moving average, they are all simple applied to close. Simple applied to median. Okay, so if both of these moving averages are showing upwards, then I'm looking generally for, especially if I want to exit my entry, I'm looking for generally for one type of a candle, and it's a, some people will call it I don't know, evening star. Some people will call it doji. Some people will call it, I don't know, different names. But for me, they let's call it, let's make easy for all of us, and we call a sword candle. You know, the reason why I call it sword is because of the fact that it really looks like sword. Okay, this candle, when you look at it, you have the handle and you have the sharp part, and this is the shield part of the sword. Imagine it that way. Okay, but when you are aiming for the market of such caliber, then we need to understand one extra thing. Okay, let's see. So we are looking at the market, and we see that the moving averages are moving upwards. Our candles are setting up such a level that it's bullish, and then suddenly we end up seeing a candle like this, which looks exactly like a sword. What does a sword generally tell us? First of all, we are looking for this level. Sword will have a small handle. Okay, we call it handle. Okay, and it has a very sharp section, sharp. Okay, and the level, this is the shield. I'll call it SHL. This should be either opening and closing at the same level, or it should be as small as possible. It must be at least, or sorry, it must be maximum of 20% of the total candle size. So this level that we are looking at, it must be maximum of 20% of it. So if the market, let's say, if the candle moved in total 100 pips, the shield can be maximum of 20 pips. If the market moved 50 pips, the shield can be maximum of 10 pips. That's the maximum. The minimum is, of course, just 1 pip or 0. Okay. Now, what does this candle really tell us? The reason why we will look at this specific candle type and not the other way around, because we can also have a candle like this as well. Okay, let's see. I generally do not look at the candles just like this on a bullish market. Okay, this is for one important factor. If the candle is just like this, okay, and it's forming over here like this, it's just telling us that the pressure is from bottom, okay? It is not from up, all right? So it is not a reversal candle that we can really consider. Just like I gave an analysis on gold last week, so I would encourage you after this webinar to go to a2zforex.com and take a look at the gold analysis that I analyzed, okay, for the last week. So if you look at it, you will see that whenever you end up on a bullish market, you have bullish candle and then the candle occurs like this, it basically tells you that it is a fake reversal candle. What you will have generally after this specific candle, you will see a bearish, small bearish candle occurring afterwards. Let me just make a different candle over here. So you will see that a small bearish candle will occur like this, and the next one is, of course, is gonna be bullish, and it's gonna just keep on going upwards and upwards. This is the market continuation in general, because of the fact that you always see the tail, okay? The tail, the long part, generally tells you where the pressure is at. If the tail is long from the bottom, it means the pressure is from the bottom. Therefore, you are being pushed upwards. So look at it from the brighter side and don't really start selling in this case. Okay, now I'm gonna bring it back just where we were just a second ago, and let's put it this way to understand what really we could achieve from here. Okay, whenever you have this kind of formation, that you have a couple of bullish candles and right after you have a sword. Again, I don't like to give things, I don't like to make things complicated. Therefore, I want to keep things as simple as possible. Let's treat ourselves as small children because we are learning. So we give special names that we can always remember. Okay, sword. The sword basically tells you that you are gonna be looking for a reversal. You have had a couple of bullish candles and this sword occurred. What do? Is that you take a Fibonacci. Okay, let's get back to our, let me just delete all this stuff. Let's get back to our platform and take a look at it. So I can give a very good example over here. I just saw one. Let's see. Just 1 second. So let's take this one into consideration, this candle over here. Let me highlight it for you. So this candle that we are looking at, okay? So we see that the previous candle is bullish, the market is showing upwards, and then we have a sword occurring. What can we really understand from it? Yeah. First of all, this is not really the greatest example that I could give, but nonetheless, this is the structure that you should be generally taking. what you do is that you go ahead and you take a Fibonacci, just connect the highest high to the lowest low, and you make sure that you are targeting 61.8 or 38.2%. Both of them are good. Okay. If your sword is already closing at 61.8, your target becomes 38.2, and therefore you would see that the 38.2 over here will already act as a major support / resistance level. Okay. Now let me give another good example for you. Now that I see a very much better example, we continue looking at the chart, and we see that the market is giving us another sword over here. This is the sword that I'm talking about. Okay. Or better, let me zoom in so that we can see it clearly. Yeah. First of all, we measure the candle. It is 35 pips. The 20% of 35 pips is 7 pips approximately. We see that this is less than 7 pips. So this is qualifying as a sword candle. So what we do, as we just discussed, let me highlight it. This is the candle that we are talking about. So what we do is we go ahead and take a Fibonacci from high to low. This is our immediate high to low, and we have to delete this highlighting. And as we discussed, we look forward for the 61.8 level. This is the 61.8. You can see that if you were to short from here, you could have already exited at 61.8. Then you are already done. It's since the chart is only on 1 hour time frame, we get only 15 pips. But once you see that the market has reversed again and it is again breaking below the 61.8 over here after you have exited, you can again short it, and this time you short it to 38.2%. So what you really get with this simple strategy is that you correctly look for the exact right reversal levels instead of going against the trend, because most of the time the biggest mistake that traders make, let me just share your answers with you again. If you look at it, I see only 5% of you guys here for more than 5 years, and 47% of you are here for 1 to 3 years, which means you are most of you guys in total 47. 21% is 0 to 6 months. So it makes 68%, and 16% of you is 6 to 12 months. 78 and 84% of you guys are in total trading in Forex for less than 3 years. So that being said, you are obviously expected to make the biggest mistakes of the traders that generally they would make, and that is entering against the trend. So if you are going to be entering against a trend, you better enter against the trend with the right mentality. You look for the sword, you see the sword, the market is pending upwards, so you go ahead and you trade with the market. So let's take another example over here, and we target not the market reversal but the continuation, because I gave you 2 types of bullish structure. Okay. The next one that we can really consider is this one. You can see that we have had a bullish market, and then we see a sword, or at least it looks like a sword, but it is upwards, as if it's showing the downside part of it. So what you do in that case is that I have to delete all these objects over here so that we can see it properly. In case of the market structure, and you see that the market is giving you a fake sword generally is a market continuation. What you do is that you place you find out your closest highest high, which is over here, and you basically take 1 pip above it, 1 pip plus your spread. So we are looking for 3 pips in total. if you're trading on 2 pips spread. Okay, and what you do is that you place a pending buy order. Okay, whatever the size from the high to the low that you have, the highest high to the lowest low that you have over here, this is our lowest low, immediate lowest low we are referring to. So let's say it's 74 pips. You multiply it by 1.5. Okay, 74 multiplied by, let's 75 multiplied by 1.5, and that makes 112 pips. So from here we look for 112 pips. Okay, and you can see that this is approximately 112 pips. Over here it's approximately 112 pips, and you will see that whenever that happens, the market will give you a resistance level. So we understand when to enter the market against the trend because of the sword that is the correct sword. Okay, and we also understand when to enter the market with the trend. Okay, this is in case where both of our moving averages are showing upwards, or one up, another one being flat. They cannot be, none of them can show downwards. Okay, moving average 50 and 200, they both need to show up, or one up, another one be flat. Okay, now let me see if you have any questions. So the question is, how do we define the sword? So we have the 200 moving average as an example and 50 moving average. You need to understand and make sure that both of the moving averages are showing upwards, or one up, another one can be flat. This, as an example, 200 cannot show downwards. If it is showing downwards, your strategy is invalid. You cannot consider it as a valid strategy entry. Okay, so you again need to make sure that if you are entering against the trend, so if you are planning to short, you need to make sure that you are as if holding your sword and you are holding it on your chest. Okay, the handle is on your chest and the sharp part is showing towards upwards, towards your head. Okay, that's a sword, and this is a sign of a bearish entry. Okay, and the way that you should be trading this is, once again, you draw a Fibonacci over here from high, this is being the 100%, and to the low being the 0%. Okay, and your target is initially 61.8%, and whenever it touches anyway 61.8%, it will go upwards. I believe generally it goes up to 100% or 88%, but nonetheless, let's not make it complicated for you. It will go upwards afterwards, and afterwards it will again come back. Okay, the second that you see the market is breaking below the 61.8, let me delete it so that it's clear. So the second that you see that the market is breaking below the 61.8, you enter again short, and your target will become at 38.2%. Okay, so you short it somewhere here, and your target is at 38.2%. This is in case, once again, your sword is a perfect sword. You're holding it on your chest and the sharp part is holding towards your head, and your moving average is showing upwards, and one showing upwards, maximum another one showing flat, just like this. Okay, this is the against the trend one. The next one, let's take a look at it once again. So we are looking at the market continuation formation. We see that both of moving averages are showing upwards, and then we see a fake sword or sword showing downwards, which shows that there is a pressure from the bottom side, from the bulls. The bulls are putting it upwards, that they squeeze the body of the candle to the top of the candle. Okay, so whenever you see, once again, such formation, what you do is that you go ahead and you take a breakout level, you define the highest high of the candle, okay? This is the highest high, 1 pip plus, and your spread, whatever your spread is, imagining that this is the spread. And what you do is that you look for a buy stop there, okay? You would be looking for a possible buy entry, okay? This is not really the best one that I could really put. So from here onwards, you are looking for buy order. The second your candle basically breaks above it, the next candle, you are going bullish. Your stop loss is gonna be at the lowest low of the recent low. So imagining that this was the recent lowest low, and your take profit is gonna be 1.5 times of your, so SL at lowest low, TP at wave multiplied by 1.5. Okay, your wave, this is your wave. So from here to the from the high to the low is your wave. So whatever is your wave, total wave, multiplied by 1.5, that becomes your take profit, and your stop loss is your the bottom of your wave. Okay. So do you have any questions right now? The question is, where do we put our stop loss when it is against the trend? Well, obviously, when it is against the trend, you need to put it at the highest high of your sword. Basically, wherever it is, you add 1-2 pips above it. That's your against the trend entry, and you know where your take profit is at. Quite often, or sometimes, you would have not very perfect risk-reward ratio, but nonetheless, if you are entering against the trend, you are very secure for the fact that your stop loss is also very minor. You are basically looking at the highest high of the candle in order to enter, okay, in order to exit the position. I guess that answers your question. In addition to that, I generally don't really care about risk-reward ratio. You should make sure that you go on a2zforex.com and take a look at a video I've done. I guess it was 2 weeks ago. It's called "Risk-Reward is Not Everything." So make sure to watch it and get the best out of it, because I know that you can really make money out of basically not really following the risk-reward ratio, but following the risk management ratios. Okay, risk management and risk-reward are complete different things. So now that we understand what really the strategy is about on a bullish market, let's take a look at the bearish side. Okay, so this is the bearish formation that we have. We see that we have 2 consecutive bearish candles, and right after we have once again sword occurring, but it's complete opposite of the bullish scenario. Okay, in the bullish scenario, wherever if we were saying that the sword needs to be upwards, in a bearish scenario it needs to be downwards. In another word, if you want to understand it even clearly, the longest part of the shadow needs to look at the trend direction, the general trend direction. So this is our trend direction. The longest part is looking at the general trend direction. Once we see such occurrence, once again, we can basically go ahead and place a Fibonacci on it. And based on our Fibonacci, let's say this is going to be our 100% in that case, and this is going to be our 0%. Okay, so once we place the Fibonacci and we want to enter, we basically enter wherever possible. and our target will be first to 61.8, and afterwards, of course, the market is going to be reversing downwards a little bit, and once again, the next attempt, whenever the market breaks above the 61.8, from here you enter again upwards and you target 38.2%, wherever it is. Okay, this is the bearish version of the reversal strategy. On the market continuation format, given the fact that both of our moving average would be sloping downwards, and let's say like this, both of the moving averages are sloping downwards, or one down, another one being flat, and we see suddenly a sword, but it's a reverse sword for a bearish strategy. So what we do is that we once again go ahead and define ourselves the wave, wherever the wave is, and we need to look for the lowest low. We define the lowest low, we deduct 1 pip, and we deduct the spread, whatever the total value is. Let's say it will be 3 pips, and from there onwards we are looking for a short entry. A short entry from here, whatever is the total value of the trend over here, let's see, whatever it will be from here to here, the total value of the wave. Let me make it. So if the total value, let's say, is going to be 100 pips, so if the level is 100 pips, we will be assuming, or we will be aiming to make 150 pips out of it, whereas our stop loss will be just above the highest high of the market. Okay? All right. Now that we understand the strategy overall, how it works, and what we could assume, this is what we should be looking at the market. Okay. First thing first, the very important factor is that you need to look at all these candles from the experience part. Okay, what I'm telling you, it requires you a lot of experience. You need to go ahead and make as much practical experience as possible, and only then apply it on a live trading account. If you go ahead and apply it on a live trading account just like this, you're going to be failing. And this is the reason is the following. Okay, we don't just go ahead and make a decision based on a candle. We have a couple of other KPIs that we need to take a look at it. The strategy involves, as I said, moving averages. So whenever the moving averages are looking upwards, we tend to avoid shorting. Okay, instead we tend to look for long opportunities. All right. Whenever the moving averages are showing downwards, both of them, we tend to, of course, avoid longing, and we will be looking for short opportunities, just like over here. Yeah, as long as the moving averages are showing downwards, we are on a bearish market. So why should we actually overall go against the trend? It would be quite silly of us to go against the trend. So the complete purpose of this strategy is not to go against the trend, but most of the time to find those swords or fake swords and go with the trend, just like we did with gold entry last week. We by the way made close to 400 pips in just one entry, and you can apply this strategy on daily time frame, and you can of course apply it on hourly time frame. I don't trade any other time frame, so I cannot really recommend you any other time frames, unfortunately. So we are looking for, and also you're going to be getting the best results for this strategy on daily time frame, because the daily time frame is going to give you the direction of the trend, and you're going to obviously follow the trend instead of going against the trend. Okay, as an example, you see that the market is as an over here, it is bearish so far, and you see that on a market where we are looking for bearish opportunities, you have this sword. Okay, when the sword is happening, bullish sword is happening on a bearish market, it is a trend continuation on the bullish side. It's not a reversal. As an example over here, the other way around, when a sword is happening, or the, let's try to find out. When a sword is happening, or reversal sword is happening on a bullish side, on a bullish market, it is a continuation on the bearish side. So you need to really start applying as much of this as possible on a practical environment. Therefore, this is what I'm going to be proposing for you, because I know we have covered something new. As a part of the strategy, I want you to go ahead and take 10 days of practice on a demo account, and you should be practicing it on once a day. Don't really look for a bunch of entries. Your entries should be mostly happening on euro dollar, pound dollar, and let's say USD Canadian dollar. And you should be looking for entry opportunities on various on two various time frames. One H1, 1 hour time frame, and the other one is daily time frame. Okay, look at mostly the swords. Try to define the swords, and make sure to join, if you are not still on our Skype group, join our Skype group as well, and make sure to follow the discussion. So each time you see a sword happening, just like over here, okay, each time you see a sword happening, ask a question: is this a valid sword? Shall I be going against the trend? And I'll do my best to help you. Okay, as an example over here, it's a daily time frame. We have a sword actually happening, but we have one thing which is not confirmed, and that is this moving average that we have is actually showing bearish. Okay, the 50 moving average is bearish, despite the fact that the sword is happening. One of the moving averages are showing upwards. This is actually not a good type of a sword. So instead, what we are looking for is looking for an entry to short whenever we see another opportunity, like over here. Okay, what is that specific information about the over here that I just mentioned? Moving averages, one is showing down, another one is showing upwards. So it means that the trend is not really completed on a bullish side. So we can look for shorting to 61.8 whenever we get the opportunity, just like over here, a break below. We short it to 61.8, and the next entry, we short it to 38.2%, just like over here, just like we discussed. And only from 38.2, whenever that happens, we look for longing once again. Whatever the trend was over here, let's say it was actually 643 pips, we long from here to 1.5 times of it. 1.5 times of 600, let's say 600 pips is 900. So approximately 900 pips, a little more, and you see that it touches it, and then the market goes bearish. Okay, I know it's very easy for me to comment about all these things and tell that it is going to be on this direction or that direction, but you need to try to apply it and try to define what is a sword. Okay, so we are going to be taking 10 days for the coming 10 days, and you're going to be testing this strategy on a demo account. And we will come back in 10 days for Candlestick Strategy 2.0, and I'll show you why I'm involving an MACD over here and what to read addition to candles as well. Okay, if you really master this strategy and you master it on daily time frame, you can just trade twice a month, no more than twice a month, and you will easily be making 500 to 600 pips per pair. That's pretty much a guarantee that I can do. But on the other side, you know, you can put me subject to any risk disclaimer out there, all the you know, risks that you should only invest the money that you can afford losing. You should not trade if you are not sure about the market, or you should, you know, acquire third-party consultancy, etc., etc. But you know, I make money using this strategy. I have made quite a decent, you know, income on this strategy for the last 10 years, and I'm using this strategy also in my upcoming Forex Not for Dummies book as well. So go ahead, look at it, try to understand the moving averages and the candles for the next 10 days. And the next webinar, we are going to be looking for the MACD. We will be covering the moving average and MACD together. And afterwards, you will take another 10 days of demo trading. The fourth final webinar, we will be looking for live entries. Probably we will actually be going ahead and setting a live entry examples on a real account that I will have. And we will be trading those. In the meantime, those of you asking what is my Skype account, what we are, I don't want to record my Skype details, but you can just type for Yagub Rahimov. This is my name. So go ahead and type Yagub Rahimov on Skype, and you will be seeing my Skype details. Okay, and I can add you to my Skype group as well. All right. Do you have any other questions for now? Right now. Trading times. As I said, we will be trading this strategy on 1 hour and daily time frames only. So don't go for a monkey business. No M5, I don't know, no 1 minute, no 15 minutes, no 4 hour, just 1 hour and daily time frames. The first training, unfortunately, was not recorded, so I can't really give the first recording for you. Additionally, to the question, I don't trade the Asian session because I live in Europe and I have my proper life. So we only trade this strategy after 8 o'clock Frankfurt time when the European market is opening, and I tend to finish up my trading latest by 7 o'clock. So 7 o'clock Frankfurt time once again. So we are looking for 8 to 7 Frankfurt time. All right, guys, we also have, by the way, a daily Forex analysis webinar starting from tomorrow on. It is on a2zforex.com. I highly recommend you to go ahead and participate in those webinars as well. It's a live market analysis every day at 9 o'clock London, 9 o'clock Frankfurt time. How many trades can we expect with this strategy per month on hourly time frame? Great question. If you are not going to be having too many of these signals per pair, you will approximately have 3 signals per week. So we are looking for approximately 12 to 15 entries maximum per month. That's per pair maximum. So for those of you, once again, asking about the daily market analysis webinars when it's taken place, please go ahead and visit a2zforex.com and go to Academy webinars. We have at least one webinar pretty much every day. We have a bunch of educational webinars happening, market analysis webinars, and we are involving now different types of trainers from different parts of the world as well. Whenever you are testing you want to test whether a strategy worked on the back of the history or not, go on a monthly time frame, put your chart to as right as possible, and since your strategy is on 1 hour time frame, press 1 hour. it will go somewhere that you don't really know when it is. So it is actually in August for me. So what you can do over here is that you right click on your MT4 toolbar, you go customize, and make sure that it is, by the way, over here. Make sure that you enable the step by step. You press the insert, close, and you will see this one. This is also F12 on your keyboard. So with this, you can just go one candle only at a time and be able to see whether or not your candles are the right one, or how much you would have possibly made for that one. As an example, would you define this as a reversal candle or not, or would you define this as a market continuation candle or not? And these are the important parts. If you go one by one per candle, you will be able to catch the right, and you will be able to learn from the history as well.